The 2008 financial crisis was one of the most significant economic downturns in recent history, affecting millions of people and businesses worldwide. It began in the United States with the collapse of large financial institutions and quickly spread across the globe, leading to a severe economic recession. The aftermath of this crisis had deep and lasting impacts on various aspects of everyday life and the financial system. Even years later, we continue to feel the effects of this turbulent period in many ways. In this video, we'll explore how the 2008 financial crisis still influences our lives today, providing insight into the enduring consequences of this pivotal event in economic history. Stricter lending standards. After the big financial problem in 2008, banks and places that give people money became very careful about who they lend money to. Before, it was easier to get money to buy things like a house or start a new shop. But after 2008, these places started checking more carefully to make sure people could really pay back the money they borrowed. This means they look closely at how much money you make, how you spend your money, and if you have borrowed money before and paid it back on time. They do this because they want to be really sure that you can return the money they lend you. Now, when you want to buy a house or start a business, you might have to show that you have a good record of handling money. If the bank thinks it's risky to lend you money, they might not give it to you, or they might ask you to pay more interest. This interest is extra money you pay for borrowing their money. For grown-ups, this can make things a bit harder. When they need to borrow money, they might need to show they have a stable job or a lot of savings before the bank trusts them enough to lend them money. This makes it harder for people to buy homes or grow their businesses. Lower interest rates. After the big financial problem in 2008, the people who decide on money rules made an important choice to help everyone. They made it cheaper to borrow money from banks. This is called lowering interest rates. When interest rates are low, it costs less to borrow money, which can help people buy things like houses or cars. And it can help businesses grow by letting them spend money on new things or hire more people. However, there's a flip side to this. When interest rates are low, the money people save in the bank doesn't grow much. Normally, when you save money, the bank pays you a little extra over time, called interest. But with low interest rates, you don't get much extra money. This is tough for people who rely on this extra money, especially older people who are retired. They often save a lot of money to use when they stop working, and they need the extra money they earn from interest to pay for things they need. So while it's good for some people because it makes borrowing money cheaper, it's not so good for others because they make less money from their savings. This is how the decision to lower interest rates after the financial crisis helps in some ways, but also makes things difficult in other ways. Increased regulatory oversight. After the big financial problem in 2008, the people in charge decided that they needed to make sure that banks follow stricter rules to prevent such problems from happening again. They created new rules called regulations, which are like instructions or guidelines that banks have to follow to make sure they are doing their job right and not taking too many risks with the money they handle. These rules help make sure that banks are being safe with the money people give them and not making careless decisions. For example, the rules might tell banks how much money they need to keep in their vaults just in case people want to take their money back. The rules also check that banks aren't making risky bets with the money, but following these rules costs money. Banks need to hire more people to check that they are doing everything correctly according to the new rules. They also need to use special software and systems to keep track of everything. Because of these extra costs, sometimes banks have to charge their customers more money for services like having a bank account or borrowing money. So even though these new rules make banks safer and protect people's money better, they also mean that sometimes people have to pay more for banking services. This is how the new rules after the 2008 crisis are helping but also costing extra. Shift in employment patterns. After the big financial problem in 2008, a lot of people lost their jobs because many companies were struggling. When businesses started to recover and hire people again, the types of jobs they offered had changed. Many of these new jobs were part-time, which means people work fewer hours, or they were contract jobs, where you work for a company for a short time or just for a specific project. This change in the job market has made it harder for many people to have stable jobs. Stable jobs are important because they help people plan their lives and feel secure. When you have a stable job, you usually work the same number of hours each week and know you'll earn a certain amount of money. This helps you plan for things like paying for your house, buying food, or saving for a trip. With more part-time and contract jobs, people might not know how many hours they will work each week or if they will have a job next month. This makes it tough for them to plan their finances and future. It also means they might not get benefits like health insurance, which full-time jobs usually offer. So while the economy started to get better after the crisis, the types of jobs people could get changed, and this has made things uncertain for a lot of workers. Housing market fluctuations. After the big financial problem in 2008, the prices of houses changed a lot. Before this problem, many people were buying houses because it was easy to get money from the bank. But then, many people couldn't pay back the money, and this caused a big problem called the housing bubble to burst. This means that suddenly, a lot of houses were worth much less than before. Since then, the prices of houses have gone up and down in different places. In some areas, house prices have gone really high, making it hard for new people who want to buy a home to afford it. In other places, the prices stayed low, and not many people want to buy houses there. This uneven recovery can make it really tricky for families to find a good place to live without spending too much money. Also, because of the problems in 2008, it became harder to borrow money from banks to buy a house. Banks started asking for more proof that you can pay back the money before they let you borrow it. This means even if you find a house you like and can afford, you might not get the money from the bank to buy it. So the way house prices changed after the crisis has made buying a home more complicated for many people. Global economic repercussions. After the big financial problem in 2008, not only did it affect places like the United States, but it also caused troubles in other countries around the world. One big example is in Europe, where countries like Greece, Spain, and Italy had a lot of trouble with money. This problem is called the sovereign debt crisis, which means these countries had borrowed too much money and were having a hard time paying it back. This made things difficult for people living in those countries because the governments had to use a lot of their money to pay back what they owed. This meant they had less money to spend on things like schools, hospitals, and roads. People in these countries found it harder to find jobs, and things in stores became more expensive. The financial crisis also affected how countries trade with each other. For example, when one country is not doing well economically, it might not buy as much stuff from other countries. This can hurt businesses in those other countries too. Moreover, because these problems were happening in many places around the world, it made countries think more carefully about their money and how they interact with other countries. This has led to changes in rules about money and trade that are still important today. So the 2008 financial crisis had a big impact, not just where it started, but all over the world, affecting economies and how countries work together. Public trust and perception. After the big financial problem in 2008, many people started to trust banks and the people who make decisions about money a lot less. Before the crisis, a lot of people thought that banks and government officials who handle money were doing a good job. But when the financial problem started, it showed that sometimes these important people and places made big mistakes or didn't manage money carefully. Because of these mistakes, people lost a lot of money and some even lost their homes. This made many people upset and worried. They began to question whether they should trust these institutions with their money. When people lose trust like this, it changes how they act with their money. For example, some might decide to keep their money at home instead of in a bank, or they might be scared to invest their money in new things. This loss of trust also affects how people think about leaders and rules about money. People want more rules that make sure banks and the government are being clear about what they're doing with money. They also want leaders who will be careful and honest. Overall, the 2008 financial crisis taught everyone that it's very important to watch carefully how banks and leaders handle money and to make sure they're making good choices so that big problems don't happen again. This way, people can feel safer and more confident about their money. So this was all about today's video. If you enjoyed watching the video, please hit a like button and subscribe to the channel for more videos like this.